Welcome, everybody. We're going to get started here in just a few minutes. My name is Tom Malingo. For those who don't know me, I am one of the co-founders, along with my wife, Susan Bryanton, who's here on the call too. We're happy to have you all here today. What we do at Brandjectory is we offer education and engagement for brands under $10 million in sales in the CPG world. We work with brands across all aspects of CPG. We have about 100 brands on the platform. We have about 125 investors who come to our meetings, such as these folks here, and work with us and help us. We also have a team of experts that engage with us and the brands on Brandjectory. And we offer a series of virtual meetings just like this throughout the month, where you get to meet, work, and engage with industry experts and industry investors, including practice pitch sessions and founder-only forums and capital raise classrooms and legal attorney classrooms where you get to ask questions. We do all this for brands. You can find us at www.brandjectorynow.com, where it goes through everything that we offer. And if you have any questions at all, you can always reach out to Tom at brandjectory.com or Susan at brandjectory.com, and we're happy to answer your questions, set up time to speak with you, and connect with you. Again, if you're a brand under 10 million in sales in the CPG world, we're very excited to talk to you and help you and see if we can get you on a good path to growth with our version of an annual accelerator program, where you get to connect with the right kinds of people that can help your brand grow. With that, today's session is a webinar with John Contrell and his partners from eGateway Capital. We asked John to join us and talk about how to position your company for exit. We all know every founder, as soon as you start your business, you're thinking about, I'm going to get bought by Pepsi or General Mills or someone. But that's not always realistic, but it is realistic to think about your exit strategy, plan for it, think about how you want to communicate it and how you want to build toward it. And that's what John and his team is going to share with us today. That's as much lead-in as I'm going to give. John and his team will present for about the next 40 minutes. If you have questions, put them in the chat. We will make sure to get to all the questions afterwards. But we're excited to have you all here. We thank you for being here. And of course, we thank John and the team from eGateway Capital for joining us today. So with that, please, if you're not muted already, mute your laptop, and I will turn it over to John. Thank you, John.
Perfect. Thanks, Tom, and good afternoon, everyone. Pleasure to connect, and thanks for joining today. I'll give a quick background on myself, and then what I'll do is I'll pass it over to Mark Sankran, who's on my team here, who'll give an overview of eGateway Advisors quickly and his background, and then we'll dive into the exciting stuff. But as I'm sure you can probably tell, not from the US originally, from the UK, grew up in the Middle East in Dubai, where I'm actually headquartered and lead our efforts from the Middle East. But my background, being in investment banking now for nearly 10 years, spent 6 years in San Francisco, focused on deep technology, a lot of enterprise SaaS transactions with the likes of Google, Apple, Facebook, the big technology companies. Joined eGateway just after it was founded a couple of years ago, and loved what they were doing, focused on digital commerce and everything within the commerce ecosystem. And with that, I'll pass over to Mark Sankran, who can give a bit more overview on eGateway, who we are, what we're doing, as well as his background, and then we can dive into the meat of the presentation.
Thanks, John. Really appreciate the introduction, and Tom and Susan and the rest of the Brandjectory team really appreciate the opportunity to speak with some of the companies that you guys are working with, and hopefully we can share some really great insights into the M&A process. So I'm one of the co-founders of eGateway Capital. We are a pretty unique company in that we're focused on the digital commerce ecosystem. And we approach that ecosystem in two very unique ways. So we have an M&A advisory services practice that John, myself, and Bruce make up. With our M&A advisory practice, we typically work with companies that are looking to sell their business. So lots of sell-side transactions. we'll also work with companies that are looking to buy businesses. And then we also have some non-transaction advisory services like exit planning or investor buyer mapping. And then on the other side of the business, we have a growth equity investment team. We've raised approximately $85 million that we're actively investing in the digital commerce ecosystem. With those investments, we typically look to write checks of $3 to $5 million per company. And our main focus is tech and tech-enabled businesses that are involved in that commerce ecosystem. Back to the M&A piece real fast. We work with a lot of different kind of companies, mainly consumer brands. We have a lot of brand background. We're headquartered in Cincinnati, Ohio, so have a lot of exposure to Procter & Gamble and Kroger and others. We also focus on the marketing space, so ad tech, martech, agencies, and then logistics, as well as software that's used to optimize kind of the digital commerce ecosystem. And now I'll give a little bit of my background. I've been in M&A for about 28 years. I started my career in New York in traditional investment banking, came back to Cincinnati after that 10-year period, and went to the corporate side where I led corporate development, so buying companies, and corporate strategy for businesses that were involved in the marketing space, as well as consumer products and e-commerce. And then, as John mentioned, 3 years ago, a little over 3 years ago, helped co-found eGateway. And with that, I'll turn it over to Bruce, who's going to kick us off with some market info.
Thanks, Mark. Yeah, I'll quickly add into my brief background. So great to meet everybody. My name is Bruce Seidel. I actually started out my career on more of the operator side, so kind of have a unique angle. Spent about 6 years in the nutrition, health, and wellness space, so both retail and brands. And then have been in M&A and investment banking for about the last 4 years. So excited to talk to you all. I'll kick it off with a little bit of insight on kind of the market as a whole, and then we'll kind of take it from there. So to start off, I think it's always important to look at a very high level about what's happening in the market, with this being a lens at the M&A market itself. A lot of you probably saw firsthand over late 2020 through about 2022, there was more capital fluctuating throughout the ecosystem than pretty much anybody has ever seen. There was obviously cheap debt. There was a ton of investment activity taking place. And there were a ton of new companies as individuals just had more time to launch a brand or launch a firm. So as you'll see in this chart, because of all that activity and because of the macroeconomic trends, M&A activity just skyrocketed to a level that's just kind of, quite frankly, unprecedented. I would say where we are today in 2024, and really what we saw in 2023 was somewhat of a normalization. So if you look at just the last year, the last 2 years to where we are today, it's definitely a quote unquote worse market. I think the really important thing to call out right here is if you look at pre-COVID, we're actually in a pretty normal spot. So the M&A market has kind of found that normalization, and it looks to be doing so for the foreseeable future. I would quickly touch on a little bit more consumer-related trends. The first thing being M&A activity in just the consumer market. So obviously, you'll see that spike was a little bit crazier if you're looking at capital invested in the deal count, especially in 2021. And I would say part of that is being a lot of founders started their brand in the consumer space over that time. So a lot of companies reached some significant scale during COVID. E-commerce, online shopping rose like crazy. And then we're kind of now at that point where if you look at the front half of the chart and the back half, we're kind of back to some normalization. To call out a couple of key trends, and I won't go through all of these, there are some unique things that are happening in the market outside of M&A that are definitely being considered by M&A investors. The first thing, which this is being talked about everywhere, is the importance of omnichannel right now, right? Over the last 3 years, it was e-commerce, e-commerce, e-commerce. It's quickly become very clear that in-store is not going anywhere. I think the thing that people were not as prepared for is how do you then blend the e-commerce, whether that's D2C, Amazon, or whatever channel it may be, with your in-store piece and your in-store presence, because that's a lot of time where you can drive that brand value. And then to quickly touch on the second trend here that I think is just as interesting is the data piece. So obviously data on managing your supply chain, your inventory, forecasting sales, that's all really important. The piece that's really unique, and there's a lot of interesting firms out there on more of the support services side and the software side, are trying to figure out how do you tie attribution and unique data from in-store to what's happening on your e-commerce channel. So just something to think about is thinking about your holistic data strategy, especially when we have rising AI capabilities that can make that a lot more effective. So couple unique trends that, and if of interest, feel free to ping us afterwards. We're happy to dive into what we're seeing, especially on the buyer front, what they're looking for. But really, an omni-channel presence is, I'd say, one of the most important things, channel diversification when buyers are looking at a kind of consumer product brand to acquire. Last piece kind of on the market itself is looking at capital. We kind of took a unique lens through just a couple of sub verticals within the consumer product space, one being the food and beverage space. This whole slide is just to call out really what we're seeing there. And the big thing, which is not a new trend, but just want to reiterate that it's still happening, is health and wellness, and healthy food is still kind of top of mind for consumers. We're kind of hitting a point though where obviously there's margin compression happening for brands, but those products you can find a way to be healthy, good for you, top of the line, but still cost effective from a consumer standpoint are the ones that we're seeing. And the ones that investors are deploying capital to, whether that's just a growth round, investment round, or an acquisition. So to quickly jump into a little bit more on topic and relevant things to what we're seeing or what we're talking about today is really talking about what the exit or liquidity options are for an investor. So really, when you're looking at the private capital markets, a lot of times it can be pretty daunting. You have a lot of firms that are calling themselves angels. You can do friends and family. You go to the private equity end of the spectrum, and there's tons of different classifications of buyers. Really, what we wanted to call out on this slide is that there are different types of capital for each stage of your business, and really trying to look through and think through what those different capital options are and what the advantages of each are. So when a brand or whatever company starts out, typically what they'll initially look to do is just find an angel investor, or a group of angels, individuals, or friends and family who really believe in the business. Typically the first stage. As you start scaling, you'll start looking to venture capital investors or growth equity investors who can deploy a little bit bigger check, a little bit being a bit facetious here. They're typically, that's, I'd say, $1 million to 5 million checks to really help scale your business. The piece to know about these capital investors is rarely will they invest in an idea. They usually want to see some meaningful product market fit, business traction, revenue traction. As you get kind of the later stage and your company itself becomes a little bit mature, that's where you get to the unique kind of capital options, which is where Mark, John, and I spend the most of our time. So thinking about M&A itself, you have a full buyout option. You can do a recapitalization to take some of your investors off the cap table and bring new ones in, but it's not necessarily issuing new shares. Or you can do a majority buyout, which is a really interesting thing. I believe we'll talk a bit too more as we get deeper into the stack. So thinking about what's happening and what you're thinking about as you're getting closer to an exit, I would call out one thing. Most companies, when they found, I'll say most being just from our personal experience talking to founders, their exit plan is an IPO, right? Or their exit plan is to get to $1 billion and then transact. The piece to call out here, and really what I want you to take away from this slide, is that the vast majority of M&A activity, of liquidity, of exits happens in what we call the lower middle market. So that's companies that are typically anywhere from, let's say, 10 million to about 200 million in revenue. Not that transactions don't occur above that, but typically that's a small minority. So as you're thinking about planning for growth and you're setting your goal, if there is a number you want to achieve when you're looking to an exit, the most likely outcome will probably be in that, I'd say, 10 to 100 million range, maybe 100 to 250 million if you're really shooting for a massive exit. Going back to that kind of majority investment, majority acquisition, or full buyout. There's really only three types of buyers in the market. Trying to simplify it down a little bit. Those three are the first being individuals. I would say that's where, as eGateway, we spend the least amount of our time. And the reason being that's typically just a high net worth individual who really wants to be an entrepreneur, who really wants to own a business, who really believes in a certain sector. That's typically, I would say, sub $2 million deals. So that is a buyer group, but really as you start moving up the kind of spectrum and get into the larger scale businesses, what you start seeing is two main categories where we eGateway spend all our time. The first being a financial buyer. The piece I'll call out about them, so that would be your private equity firm, your family offices, occasionally it can even be a hedge fund. That's a firm where their entire point of doing this transaction is to create an ROI. So they have capital behind them to buy a business, grow that business, sell that business for more than they bought. So it's all about cash flow, which typically means as they're thinking about evaluation, they spend a lot more time looking at the nitty-gritty financials, the metrics, really want to be very sure that this is a financially sound investment. The buyer group that we get the most excited about is that final bucket, and that's the strategic buyers. So they're actually by far and amount the most common type of acquirers. There's a lot more operating companies in the market than there are private equity firms. Strategic buyers, I think the really important thing to call out about them is they'll view an acquisition for more than just what's our ROI, although they probably will have some analysts who's crunching the numbers to figure that out. A lot of times it can be strategic for them, hence the name. So they might have an internal initiative to enter a new market. They might really need a new product type and don't really care if it's losing money or how good or bad the metrics look. So they're the ones that are usually willing to pay the most for an acquisition, and they're the ones who usually have the most exciting plan for the founder if they want their business to continue on with an exciting legacy. The last slide here on my sections is really the growth by M&A piece. So what I want to call out here is that a lot of times founders have this impression that an exit is the end of the line. It's binary. You sell or you don't sell. That's honestly not the case, and there's a variety of reasons for that. It very well can be where you sell, you transition out of the business, and you're done. A lot of times, though, M&A can be a really exciting opportunity or really exciting pathway to actually grow your business differently. So kind of circling back to the strategic buyers, right? If they do have that initiative, and let's say you're that product that fills that hole that they're missing, they typically have all the other pieces that go around that hole. So if you're going out on a standalone basis, and I'll think about, let's say you're a pickleball brand and you've really dominated that market. Let's say they have tennis products, they have kind of football products. They're all over the sports market, but they don't have the pickleball piece. For them to partner or acquire a company with that sector, they can immediately blast their marketing strategy to all their current paying consumers. So from a strategic door standpoint, there's a lot of doors they can open, whether that's vendors, whether that's retailers, getting your product into new places that they can do that potentially you can do on a standalone basis. The second thing to really call out on this slide is that a lot of times it's not cashing out. There's a lot of really unique mechanisms for founders to see some of that upside from the explosive growth. So, if it is only a majority transaction and you retain 15% equity, if this strategic is then able to blow that company up or blow your products up with their network, their connections, and all of a sudden you're doing 15 times more revenue than you were, your 15% equity might actually be worth more than the 100% you had before partnering with them. So there's a lot of ways to think about M&A as outside that binary, this is the end of the line, and more of this is the next step to take my company or my brand where I want it to go. With that, I'll pass it over to John.
Great, thanks, Bruce. So within this section, we're going to dive into strategic exit planning. So if we go to the next slide, I think the biggest question that often is not asked by founders is sort of what is the exit plan? But I think Tom touched it on the beginning. It sounds like a lot of you have started to think about that, which is great. But too often in this industry, we see and work with companies and founders that have a great product. They've created a strong business plan, great market opportunity with a strong base of customers. They've raised capital and they have a strong supporting team. But the question that we ask them is, so what is your exit plan? And too often, we work with founders and have founders that cannot answer this question. However, if you think about it, this question should lead to a lot of the decision making of the business going forward. And what we tend to see is when we get to an exit, a lot of chips are left on the table because founders have not really looked into, okay, what is exit planning? And they haven't maximized getting sort of the value out of the exit that they could have had if they started exit planning sort of from day one. So if we go to the next slide, we'll start diving into when you should start exit planning and what should a successful exit plan include. And in our minds, again, I think sort of Tom touched it right at the beginning, is the first thing from day one, you should start thinking about, okay, what is our exit plan? People start businesses for a couple of reasons. Obviously, there's the hand me down to the family and keep it in the family for generations. But at some point, you're going to have a succession plan. So with the succession plan, you're going to need to have a successful exit plan. What should an exit plan address? There's some key questions, and these vary per company, but these are questions that you should be asking yourself from day one when putting together an exit plan. So if we look on the left-hand side, we can see sort of what are the goals, desires, and intentions of the stakeholders. This may be very different if you've raised capital. If you've raised from a venture capital, that is obviously very different if you're sort of funded by friends and family. The next one, sort of what are the viable exit pathways? So we sort of touched on this in the previous section, whether that's sort of IPO. Again, this is sort of everybody's dream when they start a company, is let's be the next sort of, whether you're in tech, Apple, Google, whether you're sort of in the consumer space, is to be a P&G. But what are the actual likelihoods of doing that versus selling to a strategic? What is the buyer landscape? When we work with a lot of companies, we ask them this question, and honestly, it's amazing to see how so many founders cannot answer this. So we like to work with companies, and we encourage founders to start thinking about, okay, who is your buyer landscape from day one? Who are the possibility buyers of your business? Valuation expectations. So again, if you're thinking, I want to sell for 100 million, then great. But how do I get there? What are the metrics that I need to achieve to be able to go to a strategic and say, okay, I can sell my business for 100 million? Tax implications. This is one that should never be overlooked. We see too many issues with this when we come to selling a business on the tax side. And then again, what can be done to enhance value and prepare for a smooth transition? In the M&A market, a lot of the times people think, okay, I've received an LOI or a letter of intent from a buyer. Now the hard part is done. Unfortunately, over 50% of transactions do not close or are recut after receiving an LOI from a prospective buyer. So now that we sort of have all these key questions, we can start to put together an exit plan. Sorry, Bruce, go back one. And then this covers, so what should an exit plan actually include and what should it do? Firstly, it should build purposeful business practices. It should also outline the value drivers of the business for you to get to where you want to be in a position to sell. Identify the keys, do's, and don'ts of the business throughout this process and journey of the company. Again, be flexible enough to allow for changes in the business and unforeseen contingencies. Take in consideration who are the actual owners of the business and who is on the cap table. And then again, help eliminate buyer doubts. And essentially, when it comes to time to sale, maximize the chance of a successful exit. So we'll start on the next slide on purposeful business practices. So something that we like to tell all our founders and companies that we work with is get your ducks in a row. I'm not sure if any of you on the call have been through an exit before, but one of the most daunting things to receive when selling a business is a due diligence request list from a buyer. These tend to be 300 to 500 questions long. It's a deep dive into the company, make sure they're doing confirmatory due diligence on the business, and what they're buying is what you've sort of marketed to them throughout the process. Again, this can be difficult, this can be easy, and the way it's easy is by what we call getting your ducks in a row. There's many different sort of subsections that you can focus on to ensure that at the time of exit, the actual due diligence process runs smoothly. And some of the sections that we've outlined here are key ones that we believe founders and entrepreneurs should be focusing on from day one. Obviously, the first one to start with is financials. So making sure you maintain detailed and accurate financials. A lot of the times we see companies have PDF of their financials. They're only done on a quarterly basis. Balance sheets don't balance. Just these small little things can really impact when it comes time to transact. Contracts with suppliers, with vendors, making sure you have digital contracts ready. The worst thing you want to be doing at time of exit when a buyer asks for these is digging around in a filing cabinet or making sure that they're all signed or they're outdated. So just making sure that you have your contracts ready, they're in digital format, and they're good to go. This also goes from employees, from an employee database, making sure you have all of your employee data and knowledge. Often a buyer is not just buying the product, they're buying the employees as well. So they want to know and have up-to-date information on such. Unit economics and KPIs, these sort of go hand in hand. So again, what is the most important unit economics and KPIs for the market that you're operating in? We'll sort of get onto this more detail on the next slide, but make sure you are tracking those KPIs for the industry and the market that you're in. A buyer is going to want to see that. They're going to want to see the actual KPI improvement over time. And again, this is what really encourages buyers to pay up what we call strategic value for businesses. Going to the bottom line, again, key list, whether it's customers, suppliers, inventory, making sure they're all up to date and ready to go. Again, IP and tech, if you have any of that, I mean, making sure it's clearly documented, on the legal side, all of those documents are digital, you have access to them. These are going to be things that buyers are going to want to see and are going to request at the time of due diligence. Going back to the big one, taxes, making sure that you've paid all of the correct taxes that you need to. And then lastly, other is sort of details and documents of key matters, whether that's the capitalization table, making sure that's clean and easy to read. Litigation, if there's been any litigation, making sure that's properly documented and you have all of the actual forms and documentations in digital format to provide to the buyer when requested. So if we move to the next slide, we're going to start to look at value drivers. So again, identify and understanding and specifically targeting these valuation drivers, we think and we know from working with companies in the space before is key to, one, optimizing an exit and to achieve potential maximum value when it comes to doing a transaction. So again, these are just sort of a subset of things that when we're working with consumer businesses, we tell them to focus on. And as you can sort of see, there's some on the left-hand side here, which will decrease value. And on the right-hand side, you've got key value drivers, which are going to increase value. So if we had to focus on what increases value, so you're looking at diversified sales channels, you're not 100% on one sales channel. Your top product is not producing over 30% of total revenue. You've got a unique selling proposition. Again, several year track record. It's not just 6 months. You've had a huge growth in the past 6 months because of one incident. You've got actual business, greater than 20 million in revenue, and on top of that, having high net margins in sort of that 20% plus. And then strong growth opportunities going forward for the business. On the left-hand side, obviously, the decreased value is sort of the opposite of what we just walked through. So next slide. These are some of the keys, do's and don'ts. Some of them may seem pretty obvious, but unfortunately, it's important to highlight them. And we do see a lot of companies and founders that we've worked with, unfortunately, fall on the right-hand side of the don'ts. But again, these are key things that can significantly impact value. And again, the success of an exit when it comes time to looking at a buyer for the business. So I think on the left-hand side, some of the main ones is seeking advice from experts. Again, as startups, you're obviously focusing on cash, preserving cash, but the one thing you should never skimp out on is actually seeking legal advice, whether that's on the tax side, whether that's, again, on accounting, financing side. And again, with M&A advisors, seek expertise in these sections. Be proactive versus reactive in exit planning. So sort of what we're walking through today, start thinking about this from day one. Fundraising smart. If you are raising outside capital, what is that capital bringing? Is it sort of we don't like to call it, but over the past couple of years, dumb money? Or is it from investors that can really bring something to the table and add value to the business going forward? Again, don't skimp out on paying for third-party tools such as technology software that will really add value to the business, whether it's keeping track of financials, whether it's keeping track of lists, inventory. Make sure that you have all of those things in place, because at time of exit, when you want to get that data, it's important you have easy access to it. Invest in people. Motivated and talented team is going to be a lot easier to sell going forward. Develop key commercial relationships with potential acquirers. It's a lot easier to sell a business if you already know the acquirer. M&A is a lot like marriage. So if you have a relationship with those buyers, it's a lot easier for them to sort of pull the plug and acquire the business and pay a strategic value for it, versus if sort of at exit, you're reaching out to them and they need to get up to speed on the business quickly. And then again, competitors. Focus on key differentiators. What differentiates you from the competitors in the market and makes you unique? And then quickly, just to touch on some of the don'ts. A lot of the time, you might think, okay, there's a big party at the table. They're showing real interest. Let's devote all our resources to this one party. That often doesn't pan out if that partner goes away and you're sort of overcapitalized to that business. All of your sales are to that partner, and that partner goes away, you're left with sort of an empty shell. Don't overshare, again, regardless of the event or the partner that you're speaking with. This is important in the sense of we often find that big companies approach smaller companies and they want to give all their information away from day one. We would always advise against this. You're still in competition with these, so treat it that way. If there is an acquirer at the table, never talk valuations. I think on this point, I would reach out to an M&A advisor or anybody that you have close ties within the M&A space to get advice on how to handle these situations. Exclusivity and enter into restrictive agreements with potential partners. This can deeply impact sort of valuation and the effectiveness of being able to transact at time of exit. And then again, sort of a key one is think you can do it all alone or be a know-it-all. I think this one is key. A lot of us, again, when we're starting businesses, we think it's easier to try and take on 100 tasks, be the CFO, be the CEO, be the marketer. But really, it's important to delegate, but to experts, again, whether it's on the legal side, whether it's on the financial side, make sure you are delegating these to experts in the space. It will make your life a lot easier as you continue to grow the business and at time of exit. Next slide, please. So this is a slide. It's an interesting one to keep into perspective when you're going to sell your business. I think we never advise companies to time the market when they're selling, but it's important to sort of keep in mind a company life cycle. Often you get what is called strategic value for a business. So you've created a team, you've developed a product, you have beta shipments, and it's being well received in the market. Oftentimes, a big company will want to come in at this time and sort of take you out, whether it's for competition reasons, whether it's for consolidating market, whether it's they need to go into this space, and they will often pay significant amounts for the business, even though you haven't proved significant financials. And then you sort of get this volume production. If you sort of skip this stage and then you're like, no, I'm going to raise significant capital, I want to take this business to the next level. You go out and then you sort of get what we call this sort of drop in value, because the next stage you need to really go out and prove the business on a financial standpoint. So you've raised capital, you need to start volume production shipping, you need to start proving that there's significant revenue and traction in place. And then you start to get back to that, what we call strategic value by financial metrics. And that's looking at sort of revenue, EBITDA, obviously products sold, etc. So this is another one that we like to put in front of companies just to keep in mind. Next section. And then just we'll go through this one pretty quickly, but I think just the importance of an M&A advisor and why, again, a lot of the times I think companies, founders think the only real time that they should be engaging an M&A advisor is at time of exit. However, we want to change that sort of ideology. we think it's important that companies partner with advisors early on. It doesn't have to be a formal engagement. It can be more informal. Just, hey, know an M&A advisor, pick up the phone if you have any questions. But what we like to, again, harp on is that a credible advisor provides value add throughout the life cycle of a company. Some of the things that you can sort of see on the right-hand side is what a credible M&A advisor should be providing to companies early on, whether that's assisting with exit planning like we discussed today, corporate development. We live and work in the space. We have connections to all of the top buyers. Maybe you aren't ready to sell, but maybe it's just, hey, we know this great company. There could be a business development relationship here. Can you make an introduction? Help with the do's and avoid the don'ts. So if you have any questions on, oh, I'm not sure if I should be doing this, or will this add value to the business, always feel free to reach out to an M&A advisor. They live and breathe in the space, so they should know and should be able to advise you on the matter. Again, that goes to supporting with company best practices, valuation guidance, whether it's, okay, I'm at 10 million in revenue today. I want to be valued at X amount. What do I need to get to then be valued at, say, 100 million? How do I get there? They can work with you. They can provide market data and show, okay, these are the businesses that are selling for 100 million. This is where you need to get. Here's some ideas of how you can get there. Make key strategic introductions. That sort of goes back to sort of business development side of things. And then again, just generally run industry and financial analysis of your sector so you are up to date on the markets. Next slide, please, Bruce. So who and when to engage? I think this sort of goes back to the exit planning. You don't have to formally engage an M&A advisor from day one, but I think you should definitely know them, have a relationship and have a partnership with them. And then key things to consider when you are partnering with an advisor. One, are they a good partner? I think that's obviously the key one to focus on. When it comes to an actual M&A transaction, these typically are 6 to 9 month processes. So I think you often spend more time with an M&A advisor than you do with your significant other. So it is important for you to get along. Do they have knowledge on the market? So again, on the consumer product side, do they know the ins and outs? Do they know the right buyers in the space? Do they know the key metrics? Can they help with growing your business? Access to the right connections. That sort of goes back to having knowledge on the market, as well as being well informed on potential buyers. Are they experienced in selling businesses in the space? Do they understand the M&A deal life cycle? Are the interests aligned for both parties? And then again, do they take a cookie cutter approach or do they take a tailored approach? And that sort of builds on this graph on the right-hand side. Are they there from day one to sort of help you with these valuation blocks to sort of get you to maximum value at time of exit? And then lastly, what we often see on the next slide is M&A advisors at time of exit, they tend to, they help you with finding a buyer and negotiating a transaction. But they sort of then take a step away when it comes to sort of due diligence and put everything sort of on the lawyers and on the founders. But what we like to see with a credible M&A advisor is for them to sort of be the quarterback and take the heavy lifting, so that when you are going through an M&A process, the most important thing for founders is to continue to focus on the business. It is, like I mentioned, it's usually sort of a 6 to 9 month process. We want the business to continue performing, to continue going up and to the right. We don't want to see it going down to the left. That obviously is can impact valuations at time of exit. But I think as you can sort of see, and we will share the slides, I don't want to walk through all of sort of the boxes here, but you can go through this and sort of see what a credible advisor should add to an M&A process. And with that, I think we're sort of at time to go into sort of Q&A. So I'll hand back to Tom and then can open up the floor.
Thank you so much for that, John, Mark, and Bruce. And before I ask for questions in the chat here, please put them in the chat so we can make sure we don't miss any. I have a couple of questions, especially for the group that I think is on board here watching this. The first comes on your value drivers page. It seems to me for a young founder that wants to talk about what their potential exit is, that this is a good place for them to focus both as they build their business and talk to investors. It's sort of the things they need to be thinking about. Am I viewing that correctly?
Yeah, I can jump in here. Yeah, I think something that's, I wouldn't say often overlooked, but that's critical is what you're doing to position your business for a good exit is a lot of times the same things that are required to successfully scale your business. So there's significant overlap. I mean, if you are looking at doing a new partnership with a retailer, or you're in a position where you have this massive opportunity, a big co is not going to say, oh, sorry, you don't have that data, or it's taking you too long to find it. That's fine. Let's partner with you anyway. They're going to say, how do we know that this brand can carry its own and is in a position that they're going to successfully execute on this arrangement? So a lot of what we've been talking about, I would say, even if you're not wanting to think about it from an M&A perspective, it's good advice to just have a really strong, business that is positioned to scale.
That's great. And, and as we talked about at the beginning, every business wants to start talking about, who will be that partner that will buy them out? Who is the potential buyer? My other question goes to the page that talked about the strategic value and the financial value. And the, brands, I think founders need to understand where they fit. Are they so differentiated that they offer that strategic possibility, or do they really have to focus on building that very positive financial business to think about that exit? So I guess I just like to throw it back to you guys for a minute to talk a little bit about where you see and how you see some of that strategic value being built by companies, beyond the differentiation. How much differentiation, in what way, those kinds of things that might give a brands an idea of how they continue to have to position themselves.
Yeah, I'd be happy to jump in on that one. So differentiation is always beneficial, right? So let's just start there. As a brand, though, I would always be thinking about ways that I can demonstrate true brand equity. And I'll use a quick example. On Amazon, there are thousands of products that are private label that all look exactly the same, but they have a different name on them. There's not a lot of brand equity there, right? And so as you're building a brand, I would think about the different measures of what brand equity are. And as you build that brand equity from an acquirer standpoint, that's really the key thing that's going to drive strategic value. And so I think about things like repeat purchases, or being able to increase the average order value, or social media following in some cases, or net promoter scores. Anything that can kind of highlight that you actually have brand equity, which otherwise is, it's kind of hard to quantify whether or not you have brand equity and how much it is. But I think if you kind of focus on some of those metrics, like I just mentioned, that'll be a guiding point for developing true brand equity. And if you build true brand equity, that's when you attain strategic value.
That's great. And we have a question here from Jason. The frequency of M&A activity at that financial value inflection point versus the strategic value inflection point. What's sort of the balance that you feel is out there happening between those two?
All right, John, do you have ideas on that, or do you want me to?
Yeah, it definitely depends. And again, I think sort of the market as well. Like if you're working with the big brands that need to get into a space quickly, then you're sort of going to see them acquire into it, maybe from a strategic standpoint. And again, it goes back to sort of Mark's point on they're going to acquire a brand that has strong brand equity to get into that space. I would say you definitely see it more within the news. They're more prominent of the big businesses acquiring these brands that maybe don't have the financial, background to support sort of the valuations. So you will definitely see that. But I would say more so than not, you'll start to see, again, private equity firms come to play in the financial space. There's a larger market in sort of that financial space than there are in sort of the strategic value space. So the majority of the deals will be done on financials. But again, if you can position yourself successfully to be one of those businesses at the strategic value stage, I think that is key as well. So going back to building brand equity is very important.
I can
Hey,
maybe
oh, I'm sorry. Go ahead, Bruce, please.
Yeah, one additional thought there, and I think it's important to think about when an exit is right for you. And the only reason I say that is a lot of times when we see strategic value or brands looking for strategic value, it's because they have to. They're running out of capital, or they're in a position where they need to return capital to investors, but their financials don't rationalize a sale of that size. If you're thinking about the true, really exciting strategic value deals, those are the ones where the brand's still going up the roller coaster, right? They still are going up to the top, because that's when a buyer is going to say, I don't know where the peak of this is. But to be candid, that's a lot of times the hardest part to get off the roller coaster, is when you know you're not at the top. So, just thinking about when it's right for you is another piece. And that's where you usually see the most successful strategic value sales, is when a founder says, I don't know where this is going. I know it's still going up, but I'm okay stepping away at this stage.
Thank you. We do have a couple questions here, I think, from Maddie and Stephanie, both kind of asked the same thing. Sort of about finding, for a young brand, a brand that's, at a couple million in sales, 2, 3, 4 million in sales, even smaller, starting to think about where they're going. You guys definitely presented, why an M&A advisor is good to have. But of course, there's a cost to that. And so, how much or at what level can you expect, or these brands expect to find, an M&A advisor to either work with them, as a board advisor or for monetary, whatever the situation is. How can they expect to do that at the stages they're at when, they're still growing and and the money's still tight?
Yeah, I can touch on that. I guess I would start with just our philosophy at eGateway, and that's to be helpful. So we always start with how can we be helpful and where can we add value, and then if someone were to come to us and say, hey, I'm not ready to sell, or I don't need the Cadillac, I need a Hyundai, we can usually work through that in a relationship building effort. Because ultimately what we want is a long-term relationship with the company. So I do think that there's a lot of things that we can do from a just informal help kind of thing versus a formal help kind of thing at the earlier stages that again start giving you some guidance as to what direction you should go into.
And I think just to add to
Go
that,
ahead, John.
when it comes to sort of time of exit, I think one of the biggest things that drives value in an exit scenario is competition, or the perception of competition. So while there are costs that come with an M&A advisor, you have to think of it as if you are a buyer acquiring a brand, you want that brand to yourself. You don't want there to be any other competition. You want to come in, and again, if you're putting in your offer for a business, you're not putting your best foot forward with the first offer, and you're going to try and encourage them to take that offer. So sort of bringing in an M&A advisor sort of gives the perception of, oh, there is real expertise here. There is potentially a process being run in the background. I'm going to have to potentially compete with others here. I'm going to have to then pick my offer up. And what we like to where we see our expertise is really driving, okay, maybe there is a first offer on the table, there is interest at the table, is really driving that up. And more often than not, we see that value from the initial offer to sort of where we close a transaction easily cover sort of the fees that any sort of brand or seller would have to pay for an M&A advisor.
Thank you. We have another question here. It covers, I think, a little bit more about, I'm going to phrase it a little bit different than Ziad actually asked it, but there's a lot of brands that develop along the way in a number of different ways. They may have they may produce their own product. They may use a co-packer. They may do private labeling as part of what they do. They may do co-packing for others. There's a combination of ways they grow that they find are acceptable and hopefully profitable as they grow. What about companies, especially on the brand side here, where they may have their own brand, they may have they may be doing private label work, they may be producing their own product, they may be producing for others. Do you see anything special or different about a brand like that as they start to build that equity towards an exit strategy?
I'll throw out the more of your supply chain or the more control you have over your brand, the better. You know, not that it's necessarily bad to be private label. There's a lot of substantially successful private label brands, especially the ones to Mark's early point that build up meaningful brand equity and are differentiated in the market, and people want that brand, not that product. But if you're thinking about from a buyer standpoint, when they know for certain that supply chain hiccups are less likely because you have that direct relationship with that overseas company, you visited the producer in China, you have a relationship with them, and you have two backups behind them, that's really meaningful. Or you produce your own product. So there's not going to be another brand that comes in and your supplier says, hey, sorry, they're bigger, I need to focus on them. So sorry about your luck, we can't fulfill your inventory requests. So I do think when you're thinking about what a buyer wants, they want control, they want security. So having that control and security is meaningful. I would say it's less from a brand standpoint though, and more from a business standpoint, if that makes sense.
Okay. Mark or John, anything to add on?
The thing that kind of pops in my head, in most cases, diversification is always a good thing. So anytime you can diversify, whether it's SKU concentration or supplier concentration, it generally something good is going to come from that. So I would always keep the kind of the angel on one shoulder of diversification and the devil on the other of concentration, like kind of keep that that little fight in your head all the time, and anything you can do to diversify it will generally be beneficial.
All right, we got about 5 minutes left here, so we can take a few more questions. I have another one, John. You piqued my curiosity with some things you were talking about before. Can you talk a little bit more about the buyer strategy, about why buyers start looking for brands? Certainly, some of it is in the differentiation, something they don't have. But what's sort of going on in the buyer's mind as they start looking or seeking opportunities or thinking that they want to buy, as there are a lot of larger legacy brands right now we see divesting, right? You know, we see Mondelez doing it, we see Utz doing it, we see, Unilever thinking about it. So I just thought maybe you could speak a little as to just the differentiation of ones that are seeking to buy. What's those reasons right now?
Yeah, and I think it's sort of changing consumer preferences drives a lot of this. So again, one hot market that we're seeing today is sort of the non-alc space. So if you think a lot of the alcohol beverages, they may not have a sort of non-alc play, and what's sort of the best way they can start from scratch and they can start building up their own, or they can go out and look for, okay, well, who's got strong brand equity in this space already? They may not be large from a financial perspective, but they've already got the attention from the market. They've captured sort of that strong brand equity, and that would sort of be sort of, okay, that's a perfect sort of acquisition strategy. As you sort of know, consumer preferences are changing. So it's just sort of what is sort of that hot space in the market to go after. I think that drives a lot of sort of decisions from the big sort of strategic buyers of, okay, where do we need to enter next? And Mark and Bruce, feel free to add to that.
Yeah, the one thing I would add is demographics often come into play here as well. You have large beverage companies, as an example, that might over-index on a few different demographics, but they want access to the younger 20 to 29-year-old males or whatever. And like Pepsi can start and build an energy drink overnight, right? So it's not the magic of, hey, can you make an energy drink? The magic is, can you make an energy drink that resonates with that demographic? So usually what we see is a lot of times it's the wanting access to a certain demographic that drives a lot of acquisition.
All right. We have one last question in here. M&A advisor to find a strategic buyer. I think that's the one, John, if you want to talk to that for a second.
As in, would you use an M&A advisor too?
Yes. Yeah.
Yeah, definitely. I mean, sort of that's our key job. We have access to all of these strategic buyers. We speak to them on a regular basis. So I would definitely say yes, that's an important part. And I think The one thing as well of having an M&A advisor that is important is sort of keeping that buffer between buyer and seller. There's going to be oftentimes throughout a process that maybe uncomfortable questions arise, or the seller's going to want to ask for, say, again, we need more here. And it's very uncomfortable if, again, the seller's going to be working for this larger strategic going forward. You want to keep good graces. So that's sort of the role of an M&A advisor, to sort of play that bad cop middleman and have those conversations on behalf of the seller.
And I would also just add to that, selling a business is a lot of work. And you have a business to run. So there's actually a lot of value in just allowing me to focus on operating a business versus doing the deal. So having help doing the deal part is critical in my mind, because if you think about it, if you set expectations with the buyer as to what your business is going to do 6 months from now, and all of a sudden you're focused on the deal and not running the business, your financials could have an impact based on that. And the second that your revenue is not where it's supposed to be, the buyer is going to come back and retrade the deal.
Right. All right. I think we are at time here. I want to thank John and Bruce and Mark for being here today, for sharing this. We will be making the slides available and the recording of this to those who registered for the event. And they will go into the very extensive Brandjectory knowledge base. If you're not a Brandjectory member, there's 300 plus articles and videos and presentations in there, all available for our members to see. And we're happy to talk to you at tom@brandjectory.com, susan@brandjectory.com, if you're interested in joining us. To all those here who are on Brandjectory, we know, thank you for being here. I see Claudia and Sean right now on my screen, and Joshua. But to everyone else, we really appreciate this. And once more, John, Mark, and Bruce and eGateway Capital, thank you for joining us today. This was a fantastic presentation, and I hope it put a lot of brand founders sort of in the mood of what they have to be thinking about as they grow, and not to lose sight of an exit strategy, but not to overthink when and how it's going to happen. It's a tough road, and I think you gave them a lot of good insight as to how to continue down that path. And we're always excited to give folks that opportunity. So with that, I thank everyone one more time, and everyone have a great and very good day and week. Thank you all.
Thanks a lot, Tom. Thanks, everyone.